This one rule saves traders from blowing their account, and it has nothing to do with finding the perfect strategy, winning every trade, or predicting the market, because the single most important rule in trading is simple but uncomfortable. Never risk more than you can afford to lose on one trade. And most traders ignore this rule not because they don't understand it, but because emotions convince them they are different, smarter, or closer to a big win. And beginners especially enter the market believing that one good trade can change everything. So they increase position size, remove stop losses, or risk a large portion of their account, not realizing that the market does not reward hope or confidence. It punishes poor risk control. And the reason most trading accounts blow up is not because traders are wrong too often, but because when they are wrong, they lose too much. And a few oversized losses can erase dozens of small wins in seconds. And this is why professional traders focus more on survival than profit, because they understand that staying in the game is the real edge. And this rule works because it protects you from your own emotions, since fear and greed are strongest when large amounts of money are at risk, causing panic exits, revenge trading, and impulsive decisions. And by limiting risk on every trade, you reduce emotional pressure, allowing you to think clearly, follow your plan, and accept losses calmly. And many traders fail because they confuse confidence with control, believing that a strong setup deserves more risk, when in reality no setup is guaranteed and every trade is only a probability. And markets can move against even the best analysis without warning. And this rule forces traders to respect uncertainty instead of fighting it. And when you consistently risk small, controlled amounts, losses become manageable, boring, and emotionally neutral, which is exactly how they should feel. And this allows you to focus on consistency over excitement, process over outcome, and long-term growth over short-term wins. And another reason this rule saves accounts is because it prevents revenge trading, which often happens after a large loss when emotions take over and traders try to win everything back quickly, leading to even bigger mistakes and faster blow. But when losses are small, there is nothing to chase, no emotional wound to heal, and no pressure to recover immediately. And over time this builds discipline, patience, and trust in your process. And traders who follow this rule understand that no single trade matters, because success is built over hundreds of trades, not one moment. And the market rewards those who think in probabilities, manage risk, and stay consistent, not those who gamble on big outcomes. And the hardest part about this rule is that it feels slow and boring, especially in a world where social media glorifies massive wins and overnight success. But boring is exactly what keeps traders alive, because trading is not about excitement, it is about control. And the traders who survive long-term are not the most aggressive or confident ones, but the most disciplined and patient ones. And once this rule becomes non-negotiable, everything changes, because losses stop feeling like threats and start feeling like part of the process. Confidence becomes calm instead of emotional, and trading becomes sustainable instead of stressful. And this is why this one rule saves traders from blowing their account, because it protects capital, controls emotions, and gives traders the only real advantage that matters in the market, which is the ability to stay in the game long enough for skill and experience to compound.